On Monday, we saw the market lift first thing in the morning on the story that came out over the weekend that the U.S. was postponing the implementation of a second round or another round of higher tariffs on the Chinese range of Chinese products on March 1st. Unequivocally, that's good news for markets that like free trade. Certainly, no one really, from a market point of view, likes tariffs. On a specific company view, that's different. There are certain winners and losers. But in general, markets like free trade, free unfettered trades, lower taxes, because tariffs are taxes, paid by the user, not by the country that they're imposed upon, by the way. And so that, in general, should be good news for the market. And we saw the SPOO's S&P futures open up 15, get up to about 20 points higher, really showing some strength early in the day. And then as the day wore on, they faded. And they didn't actually close on the negative side, but when you close up 3 after, let's say, an up 20 day, and again talking in S&P terms, that's kind of a lackluster close, especially when you close pretty much at your lows. It really leads many market participants, myself included, to wonder whether when a deal gets done, if that will be the sell the news type of opportunity or type of event. I think as the trade frictions have seemed to ebb over the last few months, that's probably one of the catalysts for the rally that we've seen year to date. I think people were very worried about trade worries the end of last year, and this year there's a lot more friendly talk coming from between the two countries. So that I think that's been a very positive backdrop to the market. But now I think there's a couple of concerns. First of all, how much good news is priced in? I think there's been enough rumblings that we may be close to a deal that some of that is priced in. Secondly, what kind of deal are we getting? It's definitely a fear that in the rush to get a deal, that it may not be the deal. And it's very interesting to think of, from the Chinese point of view, how they benefit and what their risks are. I think in many ways it behooves the Chinese to string this along and give up a little bit in the short term. Why? Because President Xi is essentially president for life. So his time horizon is measured in decades, as opposed to measured in 4-year terms, of which half is expired, which is how our president is kind of forced to view it. So as long as the Chinese can keep their economy from completely plunging, and the rallies that they've seen in their stock market are saying that people are optimistic on their side about the positivity of a deal, it behooves them to give something but not everything. I think the most important things that we could negotiate for as the U.S. are the protections on intellectual property and the lack of requirement of joint ventures by companies doing business in China. I think that's going to be something they're going to be very loath to give up. And so if you end up with a deal that basically just makes some concessions on steel and soybeans and things like that, I think the markets will ultimately be disappointed. I think they were hoping for some structural reform. I hope I'm wrong on that. But if you do see what I would consider a light deal, or the sort of deal that gets pressed by saying, well, they made a deal but not the deal, I think you have the very high likelihood of seeing selling on the news, and I think that what we saw Monday might be the beginning of that. Stay tuned.